Okay, folks, welcome to Best Stock Charts for the coming week. This is Bob Desmond at the Contrarian Trader, and we're going to kick things off with a question that was posed to me on Friday by one of our members. And the question was that, will I still stand by the call I made on January the 16th stating that the stock market rally was simply unsustainable? It's still posted there on the 16th. I do still stand by it. Now, the reason why he asked me was that we had just stopped out of SPXS, which is a leveraged ETF, which puts you short of the S&P 500. And also, we had taken profits in our short of the semis using the SOXS, which is another leveraged ETF. And my answer to him was that while, yes, we took a tactical approach to stopping out of our short of the S&P 500 and we booked profits on our short of the semis, nothing has changed. I'll go to the charts in a moment, but nothing has changed. In fact, after we stopped out, the market continued higher. And as I've been saying to members for weeks now, traders, and I'm including institutions here because the volume bars, the up volume bars on these indexes are massive. They are whistling past the graveyard. Let's get to the charts. Now, what do I mean by traders are whistling past the graveyard? And what I mean by that is that the market is a mechanism that sends you signals. You can complain about algorithm trading this and dark pools that, they can't give you a fair price, yada, yada, yada. I've heard all that. When you learn the charts and you learn the market signals and you appreciate the history of the stock market, you become a very profitable trader if you're willing to show patience. And trust me, showing patience was a learned behavior on my part. It did not come naturally. And it cost me a lot of money finally adhering to a policy of endurance, waiting, and acting appropriately. Now, the chart in front of you, I purposely blocked out the symbol, but I want you to take a moment and look at the price action, look at the RSI up here, and ask yourself this question. This is a monthly chart. Ask yourself this question. Would I buy this stock or ETF given the price action as it looks right now? Think about it. Would you buy this Monday morning? Or does it look more like a short? Again, monthly chart. Now, I'm sure that most of you out there said, you know what, Bob, of course it's a short. It broke down below the lower band of support here. It's a monthly chart. This is a massive breakdown. You have lower highs, very close to a confirmation breakdown here on a close below 146.46. RSI, lower highs. It has broken down to new lows. So we have a confirmed breakdown if we close out the month where we're at right now or lower. Ultimate oscillator, lower highs and lower lows. Stoke RSI, a recent rally, smashed. Stokes. For you folks that trade off of using the Stokes, you know exactly what this problem is here. This is a nightmare in the making. Talk about the mother of lower highs with the stochastics rolling over. So if you folks were out there thinking that, you know what, it's probably a buy, it's probably oversold on a daily chart, you probably get a pop, maybe you're right. But longer term, that's not the trade is. It's a monthly chart. We're looking at it for a reason. What is the overall direction of this chart? And what are the probabilities as we proceed into February of this trend continuing? And why am I being so long-winded in getting to the symbol of what it is? It's because every single bubble over the past 30 years has been pricked by a rise in interest rates. And what you're seeing right now, and the chart that you're looking at right now, is the 30-year bond price, not the yield, but the price. Now, if we have prices breaking down, what does that mean for yields? Obviously, they're going in the opposite direction. What is the probability of us making lower lows in February? Quite high. Now, why does this matter? As I just said, you have seen bubbles pricked because of rising interest rates, and of late, over the past 15, 20 years, big stock market rallies have been pricked by interest rates that rise to lower prices, meaning they don't need to rally as much anymore to prick the bubbles. Why? It's because we have so much debt, and our interest payments, as rates rise, increase dramatically, and it sucks capital out of the U.S. economy, and it sends it overseas. What else are we looking at? This is the Pring Inflation Index. Folks, we're poised right now to close at levels this month. This is a weekly chart at highs not seen since June of 2015. Gold, overlaid here in gold, is breaking out. The U.S. dollar. You had Steve Mnuchin, our Treasury Secretary, come out the other day, and he pretty much advocated what everybody knew, is that the U.S. government has a weak dollar policy. And it's not a Trump administration thing. It's gone back to the Clinton administration. Robert Rubin always talked up the U.S. dollar, yet it declined. President Trump has stated in the past during his presidential run that he was for a weaker U.S. dollar. But as president, he walked back to statements of Steve Mnuchin, but the markets see right past that. So we close right near the lows of the week, and we are very close to touching support last seen back in 2014, December of 2014. And if you take a look at the 50-period moving average on this weekly chart, it's going to take out, absent an act of God, the 200-period moving average. So the U.S. dollar is really getting clubbed like a baby seal. And you're already beginning to see signs of weakness in the market. Last week, the transports closed down the second consecutive week in a row. Now, could this be a pause that refreshes after a huge run? Absolutely. But they are not confirming the move higher in the Dow Jones. So if this continues, what may be a non-issue right now could become a dramatic issue. These are market signals. It's up to us to either decide whether or not we want to appreciate them, acknowledge them, file them away, and possibly act on them, or ignore them. And you do so at your own peril. Now, if the sell-off in the transports came on light volume, I would be a bit more dismissive of the price action, but this is not light volume, folks. This is institutional distribution. So we had an inside day on Friday. We may see higher highs next week. Before we go to the charts that we're looking to sell short, we're still long the market. We're still enjoying profits to the long side, despite the fact that my outlook in the short term and intermediate term is bearish. We're still going to stay long the market because the market can stay irrational for an extended period of time. But we are on borrowed time. There's no doubt in my mind about it. Now, the charts that I'm going to look at and discuss today are honestly charts that I went over yesterday, and they were submitted to me by my members who are very smart people. A weekly chart, AMN, it broke out above resistance yesterday. We expected it, and we closed there. So we're very excited about AMN, Alibaba, weekly chart, an international play. A huge breakout last week. We'll be looking to buy this one. Volume, outstanding, good stuff. And we're going to talk about these charts more on the week ahead commentary and also our strategy for shorting this market, because there's going to be a lot of money made. You just need to be positioned right. And with the markets in a blow-off top right now, if you don't short the market right, you'll probably get stopped out of your position right before the market sends you a signal that it's all clear to short the market. And we'll talk about those signals in a moment. The next chart up that we're going to look to long this coming week is U.S. Steel. Now, we actually traded U.S. Steel last week. We booked profits. But the reason why we booked those profits on U.S. Steel, despite the fact I'm still bullish on it, is because we were not above resistance. We were right at resistance. The shares began to pull off the highs of the day, and folks, I'm worried about a reversal day, a big bearish reversal day. So I'm raising stops and booking profits quickly on my longs. And with regard to U.S. Steel, I believe it's heading higher, but I'm not going to gamble at resistance. I want to see a close above this resistance level, and we'll look to buy U.S. Steel. So I'm very excited about it. Not quite yet, though, as a longer-term play. Another chart we discussed yesterday, and this is a member stock chart request, is BZUN. We continued higher, which we expected. We have resistance above. We'll be looking to buy this one on a close above resistance because there's no overhead supply. No sellers looking to get made whole. So those are the longs that we're looking to put on in the coming week. And we're going to hold on to our current long positions as well. All right, to the symbols that we're looking to short. And let's first talk about what a top is going to look like. One day, it's probably going to be on a Monday or a Tuesday. You're going to wake up and the futures are going to be up on the Dow triple digits. And then by 10:30, you're going to see a pause, perhaps some selling. And then by the end of business that day, you will have seen a bearish key reversal on the major indexes. That'll set us up for another 2 days worth of downward move. Then we'll pause. We'll then rally back. Then the test is always at the top. Do we take out prior highs or do we roll over? But it's that bearish key reversal day that you'll really want to pay attention to where your stops are at. Should you move them up, or should you just look at the charts and say, okay, I see what the guy's talking about. We have the Dow Jones Industrial Average, the S&P 500 with RSI on weekly and monthly levels that they've never been at before, ever. Maybe the guy's got a point. Now, what's this top going to look like? What's this correction going to look like? Is it going to be a breakdown, meaning a la 2007 into 2009? Or will it be a simple correction, 10, 15, 20%? You know what? I don't know, right? That's the most honest I could be. I don't know. I read that in my first business book, What They Don't Teach You at Harvard Business School. If you don't know, just say you don't know it. All I know are the facts. And what are the facts? We have a tremendous amount of debt, and the debt is only getting larger. The tax bill did nothing to address spending, and the spending is only going to grow because now we have an infrastructure plan that's going to come to the floor, and they're going to pass it. That's another $1 trillion. The GDP data that was released yesterday, there was a huge miss. They were expecting 3.2. It came out 2.6. So while I voted for President Trump, I support President Trump. I want the guy to succeed. I'm not buying the BS that the economy is booming. Yes, people are spending more because they're feeling more confident, but I'm not buying the BS yet. And we're not going to know whether or not this tax reform package is going to be successful until we get future GDP reports out. And between now and the end of Q1, do you actually think that the Dow Jones weekly chart is going to be able to maintain this trajectory with RSI at 92.03? I'll let you folks answer that question. All right, let's get to the symbols that we're looking to trade to the long side, which will put us short of the stock market. SPXS. We were stopped out of this one with a small loss. And this is what I mean by losses are good, because we're living to play another day. We have our capital reserves, and it looks as though, looking at this chart, while I would love to say the path of least resistance is probably now to the upside, it's not. It's to the downside. Nothing has changed on a weekly basis. But what we're going to do with members on all of these charts, we're going to drill down to the daily charts and into the intraday charts, looking for divergences, looking for opportunities to open up a short position. And we'll do so in increments. Now, on RSI weekly basis, we have RSI at 10.49. This is not on a stock, folks. It's on an index. SOXS. We shorted the semis last week. We had a nice sizable profit, but Intel's earnings just killed that, and we booked a small profit. And thank God we took it, because the shares of SOXS just continued lower, and we closed at the lows of the day. So what are the probabilities of us continuing lower into next week? They're fairly good. But take note of this. RSI, while price is breaking down to lower lows, RSI is not validating it, nor are the Stokes. And in fact, the Stokes are beginning to hook up. The market sends us signals. You just need to be willing to have an open mind, not necessarily act upon those signals immediately, but file them away. And all of a sudden, a mosaic, a picture begins to form, and then you'll know that the probability of this downtrend continuing is very unlikely, and in all probability, you are going to get a counter trend move. How high would that be? I have no idea. I am not that smart. So these are the charts that we're looking to build positions in and get short of the U.S. stock market. And I'm not talking small positions. I'm talking a very large position shorting the U.S. stock market in the coming days. Because again, folks, the probability of this uptrend, back to the Dow Jones, let's go to a daily chart. The probability of this continuing is extremely unlikely. Is there a reason why, a logical reason why this should be occurring right now? Sure, yeah. The market is a forward-looking mechanism. The corporate tax cuts are going to do wonders for the bottom line of U.S. corporations. But Morgan Stanley came out the other day and they said it's fully priced in now. That's it, folks. Enjoy the remainder of your weekend, and I will talk to you soon. Be well.